Record. Right. So what I'm gonna do just now is I'll just follow this order that I'm seeing here. So let me start with those with questions. Then after those ones are done, we'll move on to the others. Remember what I say that everyone must ask at least one. If you have more, that's good. So let me see, Huma. Who can I start with here? Who can I start with? Who can I start with? Let me start with those. With Benning. Greetings, Mr. Michael. This is the first one. So others, you can even okay. So this is the first person. Marcus, let's say you're there. I've opened trades that are running from Friday until the market closed. I just want to know if it's safe to hold trades until the market reopens. Even now, you can't close them, even if you want to close them, because the market is closed. So what you mean by is it safe? You need to wait for the market to open. Once the market is opened, you need to see if your analysis is still if it's still in your favor, right? There's no need for you to, let's say after the market opens, then you come out. There's no need to do that. So it's all a matter of um it's all a matter of knowing your analysis. Then if your analysis if it's still respecting your analysis and setups, there's no need for you to come out. Right. So you can start asking your questions now. You can start asking your questions. Should I follow this order? What do you think? Should I follow this order or I should start with those ones with questions? Should I follow the order or start with those ones who are ready to ask? Should I follow the order? Let me hear from you. Should I follow the order that is there or I should just start with those ones who are ready to ask? Let me hear. Let me hear. How do you calculate? This is the first question. How do you calculate the lot size? You don't calculate the lot size, you put the lot size. That's the first correction there. How do you calculate the lot size and pips for all different pairs for the stop loss percentage? Somebody asked. Okay, somebody asked. I will answer that one. You must ask your own. I'm answering that one. So what I'm saying there, it's you don't calculate the lot size. You simply there are apps that you can use whereby they actually can give you they can calculate a lot size for you. Let's say you tell them that they'll be having an option whereby they'll say put your account balance, let's say $1,000. Then they'll ask you which pair, let's say you're trading GBP USD. This one, the one that I've seen so far, and also for the crash and bombs, I've also seen other one. But personally, I don't use those apps now. But for someone who really wants to learn, you can actually use those apps. You can actually use those apps. The one that I know for crash and boom, if you go to Google Play Store, you search for synthetic it's called synthetic what? Synthetic indices calculator. Yeah, I think that's the name. Synthetic indices calculator. So this one, it will help you now to calculate those things that you want to calculate. It will ask you about your balance, your account balance. After it asks you about your account balance, it will ask you about the pair. For synthetic indices, obviously, you won't find the GBP USDs. You only find synthetic pairs. So it means for crash and booms, you use this one. Then I believe there are also others for currencies where they actually ask you the balance like that. You put the pair. After you put the pair, they'll ask you how much percentage do you want to risk per trade. Let's say you want to risk on that particular. Let's say on that particular opportunity you want to risk. Let's say you want to risk 5%. 5%, that's like 0.05, like this. This is 5%, right? So once you put these things, they'll actually what they'll do is they'll actually give you the lot size that you have to use. If you have $1,000 account and you want to risk 5% on that GBP USD opportunity, they'll actually tell you use 0.01 or use 0.03 or use whatever 0.05 or whatever, depending on the pair. depending on the pair that you are trading. Depending on the pair that you're trading. Right. How is it application to use? It's applicable to use SMC on mobile phone. Mobile phones, they are not the best gadgets. A mobile phone, it depends now with how big the mobile phone is. I don't usually advise people to use mobile phones to analyze simply because they are too small. They are too small basically. They are too small. Too small to really have a full view of what is going on the market. They are too small, definitely. Unless you have a bigger, even if you have a bigger one, but try by all means to have a laptop or a desktop. Try by all means to have that one, or even an iPad or whatever. Anything big, even a tablet, anything with a bigger screen, or it's to your greatest advantage because the screen is bigger. The chart is also bigger. You can see almost everything that is happening on the chart clearly without any false information or without any information that is not appearing there. So mobile phones, and also if the mobile phone is too small, you can use it in landscape mode. Landscape mode, that is where you flip now. You have to flip it to landscape mode whereby it's no longer the same, like you're not viewing it in a horizontal way, but in actually a vertical way. That's how you can start to analyze. Is it applicable to use SMC on a mobile phone? There's no restrictions to what you can use or not use on a mobile phone. The only thing that I'm talking about in terms of size, it's too small. It's too small. It's too small. What's the next question from there? Right. The next question is how to I pick correct POI for entries. Most of the time, my entries is stop loss just after the change of characters presented. I'll look for entries small time frame, but it will eventually stop. My question is, what's the best process to get accurate entries? Right, that's a deep one. That's a deep one, which is also right. So when it comes to entries, there are things that you need to take note of. There are things that you need. Where do I unmute the speaker? First time joining in. Come on. Someone help him there in the chat box. Right. So I'm saying first time when it comes to entries, when it comes to entries, there are things that you need to be aware of. All right. You need to be aware of where are you taking the entry? Are you taking the entry on a higher time frame or on a lower time frame? That's point number one. Right. Because when it comes to point of interest now, when it comes to point of interest, what you call POI. POI is simply an abbreviation for point of interest for those that don't know. Right. POI means point of interest. A point of interest is simply a zone that you'll be looking forward to take your entries from. I can say the zone where you are targeting the market to give you a set of action to enter. Right. So those that have heard me or seen me analyze before, heard me, or whether through the classes or whatever, or through Zoom or whatever, you realize that we have two kinds of entries on the market. Number one, we have what we call the liquidity generating entries. Number two, we have what we call the liquidity collecting entries. Right. So you realize now that by the time we have this, what we call liquidity generating entries, what is going to happen is, let's say, let me just give you a simple practical example here. Let's say we're coming down. Let's say this is our swing market, which is bearish. Let's say we're actually anticipating it to continue being bearish like this, right? So if we're anticipating it to continue being bearish like this, let's say this is our swing structure. I'm talking about swing structure. Let's say that was our lower high, lower low swing structure. Lower high, lower low, lower high. So if that is our lower high, let's say we have an extreme order block here or an extreme supply zone here, right? So this extreme order block or this extreme supply zone there, let's say that is we have let's say it's untapped. It's untapped. Below it, you find that there's inducement. Inducement, this is the first pullback that you'll find that will not touch the zone like this, right? Let's say there's an inducement like that. So now it means if ever we are going to enter any entries from down here, remember order flow here is bearish. Order flow being bearish, it means momentum is going to the downside. Momentum going to the downside, this means sellers are much more in control than the buyers. So what is going to happen is, for example, here on this drop that happened, you realize that from down here to let me remove this. Let me erase this. You realize that from the bottom, which was around here, up until they came out of from that lower high. There was sort of like a channel or a trend line. So that trend line now, the breakout there, I'm not really looking at the breakout of the trend line alone. No, I'm also considering the break of structure, the break of the previous lower high, lower low. I mean, the break of structure, which is the break of the previous lower low, as well as the breakout of that channel, right? So that entire move that you would have taken, that is what we call a liquidity generating move. Meaning, even if you sell here after the breakout, or let's say after the break of structure, you sell immediately or whatever, right? Those entries that you would have taken, those are what we call liquidity generating entries. What you need to know is after liquidity has been generated like that, the market or the institutions, they'll move price back up into the premium before they continue selling. Move back into a premium before they continue. They continue like this. So most of you now, this is where you're getting things wrong. Number one, you plot the wrong lower highs and lower lows. That's point number one. Point number two, you draw the wrong. For example, let's say someone could have drawn a supply here. Let's say there was a supply there. Then you realize above here there's also a supply. Then you realize above there there's a supply. Once they are like that, every supply that will be below this one, like if there's an extreme supply like up there, which is untapped, right? Below it, you can also see that there's inducement. Or if there's no inducement, you'll find that there will be equal highs. Something of that sort. So that being like that, it's a stronger zone for the institutions to push price to. They actually prefer to use these zones more than. So these ones below here, they can simply be used also as liquidity. They can simply be used. The market can come there, drop a little, break above, retest it, and continue going higher. So make sure that every supply and demand zone that you're going to be entering from, if you're going to be entering based on supply and demand, make sure that every supply and demand, number one, make sure that the market would have collected liquidity. For example, in this case, if we are trading from this supply, it means liquidity has been collected all here as it was going up. Even inducement there was collected. They've collected a lot of liquidity. Number two, that point of interest is still within our structure. Our structure referring to our lower high. My lower high is around here. That's where my lower high is. So my lower high being there, it means, let me just put this as a, right. I think it's much better now. So my lower high being there, me taking in the sell there, I'm not even opposing order flow. I'm in line with order flow. So all those points are points that you must understand and know before entering any trade. You must understand all of those things. So these supply zones that you draw below here, these ones will simply be used as liquidity. Same thing even when we are going up, let's say swing structure is going up. Let me remove this. Let's say swing structure is going up. If swing structure is going up, so it means in this case, if swing structure is going up like this, let's say we are going up like this, up. These are swing levels, right? So if these are swing levels, let's say our extreme demand is here. If that's an example, break of structure, break of structure, break of structure, break of structure. Our swing, this is our higher low, higher high. So here you can have something like this. This is now internal structure now, internal, up until they come to the extreme demand. You realize that up here, there were so many demands. There was this demand. Here, you can also find another demand. The reason why they are being broken is because there is an ultimate demand that they are targeting, of which that demand down, they realize that there is a lot of liquidity that is lying above it. That's why they are targeting to use this one more than others that are above there. Others that are above there, they are simply, sometimes you can even find a demand or a supply zone that is on a double bottom, a triple bottom, which is already a liquidity zone like that. So they usually take out every demand or supply that is on a liquidity zone or that is attached to a liquidity zone. Most of the times they take out those levels. Most of the times, 99% of the time, they take out those levels. They prefer to take out all liquidity. So meaning, if ever you're going to take any trades, make sure that supply or demand liquidity has been collected. Liquidity has been collected on that particular supply or demand that you are taking. So even sometimes where you don't find an adjustment, let's say you don't find an adjustment or you don't find equal lows or equal highs, and there's now your supply or your demand. What they usually do now, they come to test the previous low or previous high of that particular move. Let's say in this case, this is our swing low, this is our swing high, right? So if there's no adjustment or whatever, most of the times they come, they test this leg, reject, close above, they they reject and candlestick bodies, they close above, then they go up. So doing this, what have they done? They have wiped the liquidity that is lying below this leg. So they usually do these moves when there's no liquidity above here, whether there's no equal lows like this or there's no adjustment. They usually do this particular move before they go. So meaning if you're going to take a buy there, you wait for them to wipe. After they wipe, then you jump in upon the rejection, stop loss below, then you go up with them, targeting that one. So that one, I hope I've answered. I hope you're answered. I hope you're answered. If you're answered, you just say answered. If you have another question, you ask her again. Up until clarity. Wonderful. Right. Let me move on to the next question. Next question. What is it saying? Next question. I heard you saying the size of candlestick can tell you how the market's going. Can you explain to me how? That's a beautiful question. The size of the candlestick, it can tell you something about where the market is going, what is really happening on the market. Okay, let me go back to my whiteboard. Right. The size, when I'm talking about the size of the candlestick, I'm referring to the body. You see that some of the bodies they are longer than others. Right. What makes that to happen is momentum. Momentum, if it's strong to the downside or the upside, the size of the candles, you actually see the size of the candles will be so different. Let me see if I can give you a practical example. Let me give you a pair that is crash. Let's go to boom 500. So the size of the candlestick, that is also an art that you must learn to read. Once you read how the size of a candlestick is looking, you can also be able to differentiate where the momentum is going or where it's coming from. Let me go to the 4-hour so that you see how the sizes are so different. The sizes of these candles, they are so different. So you see, in this case, you see that the bullish candles, they seem to be more longer than the bearish. Same thing, bullish, they are much more longer than the bearish ones. This was due to the momentum that was going to the upside. Even when the momentum is about to deplete, you see even them reducing for example, here every time a pullback was imminent, they would reduce their speed by reducing also the size of the candles. bullish candles, then increasing the size of the bearish ones. That was if ever there was a pullback. But after the pullback, you see them going back to their size, going back to their size like that. So the size of the candle, it can show you where the momentum is going. Just the size, looking at the body of the candle, looking at the size of the candle, it can tell you a lot about how the market is behaving currently. Let me see. Afternoon. I would like to know your review on RSG markets and if it's legit. Right, RSG markets so far, based on what I've seen, what I've heard, what I've experienced, so far it's still doing okay. So far it's still doing okay. So far it's still doing okay. So far you can actually test it out. But the brokers that I recommend now, so that I answer everyone, even those that I haven't asked, there are brokers that have been in the game for a very long time, that have stood the test of time. These ones, these top two have accounts in these top two. These are the RCG markets, what. These are local brokers, and most of the local brokers that we've seen, they have never withstood the test of time. They've never most of them, they end up closing unnecessarily from nowhere. So Deriv also, it's also a synthetic indices broker, remember. This also stood the test of time as well. So these are brokers that have accounts in brokers that are well-known, brokers that have been in the game for a long time. Rarely do you find such brokers closing from nowhere, whereby you actually wake up one day and they've closed or they've frozen, whatever, or they're having issues. No. So just have an account with brokers that are known. That's the best advice I can give you. Don't these local brokers, yes, in as much as they might be working now, I don't have an issue with them, but I'm just saying, based on what I've seen so far, you can actually realize that, let's say by any chance they close, there's nothing that you're gonna do because they'll just go with your money and nothing you're going. So it's best to create accounts with brokers that have been in the game for a while. My bad evening. Hi, Mr. Mike. How to spot liquidity? Sweep and fair value gap. Which other blocks are good to be traded? I think I answered that last one. I think I answered on which other blocks are good to be traded. The ones that would have collected liquidity, the ones that are aligning themselves with the current order flow, the current momentum. You need to know the proper lower highs and lower lows. That's how you know which order block is going to hold and which one is not going to hold. The ones that you find in between, if they're not extreme order blocks or extreme supply and demand, most of the times, if ever at the extreme levels, they'll wipe out those ones that you find in between because they will be used as liquidity. There will be a lot of liquidity lying below them. So if an order block has a lot of liquidity lying below it, 99% of the time they'll collect out or they'll take out that order block. Right. They'll actually use liquidity sweep that you're saying. How to spot liquidity sweep? Liquidity sweep, it happens in so many forms in fair value gap. Fair value gap, you'll be having three candles. Three candles, let's say this is a bearish candle. Bearish candle, let's say this is the body, tail, tail. Right? Then the next candle, let's say strongly bearish like this as well. The last one is also bearish like this. So in this particular case, let me put it up like this. In this particular case, where is my fair value gap? My fair value gap is the low of this and the high of this, like this. This zone here is what I consider a fair value gap. Fair value gaps are what I normally say they are magnets on the market. Why are they called magnets? It's because another name for fair value gap is what we call imbalance. And imbalance, it simply means the market is not balanced. And what they will do is once they go, they'll come back to balance the market by tapping into the imbalance, then they go. So most of the times you find that imbalance will be connected to an order block. You find that your order block is somewhere around here as well. Put it, these are high probability opportunities. If the market was bearish, then you come to a situation like that, they pull back into another block, fair value gap like that. That would be a high probability because momentum is bearish, and also the zone that they've selected is a high probability because of the order block as well as the fair value gap like that. We don't only have the order block on its own. So that's how you see fair value gap. Then liquidity sweeps. Remember, liquidity on its own. What is liquidity? That's the first thing that you must know. Liquidity is simply the stop losses of retail traders that you find on the market. So the stop losses of retail traders, where are they found? They are found on zones where which retail traders use quite oftenly. Which zones and which structures or which chart patterns do retail traders use quite oftenly? So these are the forms of liquidity that you'll find on any market. There's what we call trend line liquidity. There's what we call equal highs liquidity or equal lows, equal highs or equal lows. Trend line liquidity like this, trend line liquidity. That's number one. Number two, we have equal highs or equal lows liquidity, right? So those are the top major forms of liquidity that you see on the market, right? So the trend line liquidity, what they do is simply they can follow a trend line for a particular time, not following it in the sense that maybe they are respecting it, but just in the sense of them generating liquidity. After they've generated a lot of liquidity for a long time, let's say in this particular case, let's say our swing move is this one, like this. So this is my lower low, that's my lower high, right? Come to a supply, whatever, then they drop from here. Then they drop from this supply. Let's say they drop from this supply. Like this, like this, like this, like this, like this. So before they take out this low, what they will do is there's a trend line that will be following this structure like this. So remember here, they changed inner character, but they left also a what? A supply there. Untapped supply, fair value gap as well, whatever. Before they take out this, they'll come back, collect this. This is trend line liquidity. So even here, they can come and create equal highs like this. So long as now equal highs, that's also liquidity. So long there's still liquidity there, they'll come back, wipe all the trend line liquidity, all the equal highs, tap into the institutional zone, which is a supply, an order block or a fair value gap, then they drop. So that is how you identify liquidity sweeps. Liquidity sweeps, you identify them in that form whereby I said we have two forms of liquidity, two major forms of liquidity. That's what we have. So what else do you look for entry setups apart from break of structure? So many things. Break of structure, change of character, and fair value gap. What else do I look out for? I look out for the Fibonacci. There are so many entry models that we have, or entry criteria that we have, besides what I said, break of structure. We look for a lot of things. Most of the things, as I said, structure is very important. Structure is very important. Structure. Who is this now? The structure of the market. Your proper and correct low highs and low lows, right? The Fibonacci retracement. I use it very oftenly. Number three, whether it's a break of structure or change of character, whatever, we look at that as well. We look at that, which you actually mentioned, BOS, change of character, fair value gap, whatever. Right? Number four now. These are the most important points. Liquidity, has it been collected? Has liquidity been wiped? So if it hasn't been wiped, either they'll come and take out the inducement, which most of you guys, you don't even understand. They don't take out the inducement, they'll take out equal highs or equal lows. Equal lows or equal highs like this. If there's none of this, what they'll do, they'll come and sweep that high or that low. Sweep the high or the low. Sweep the high or the lower, then close above, then they fly. Once you see these top four things, right? The last few things, last other things to look out for are just simple candlestick rejections or candlestick patterns. Candlestick rejections and or patterns. So that would just be an extra confluence. That would just be an extra confluence to a trade. Let's say you come to an extreme supply and you see all this. Those are high probability setups, high probability opportunities where even the risk structure. So the structure, it has to must have fully changed or fully still within our range. Still within our range or fully changed. Fibonacci retracement, most of the times when they are doing pullbacks to extreme demands or extreme supplies or extreme fair value gaps, they usually like the 78.6, 88% or 88.6, whatever you want to call it. 88%. Sometimes they can come as far as 100%. 61.8, yes, they do come, but they usually prefer these ones because that's where most of the extreme supply or demands, that's where they'll be found there, around those SIB retracements. So the break of structure must be a correct break of structure. The change of character must be a correct change of character. The structure must be correct. Most of you, that's where you are still facing headers there. You are still drawing incorrect structures. So long structure is incorrect, everything else that you do will also be incorrect. The trades that you take from that zone will be so incorrect. Right. So that's the answer to that one. Let's look at the next question. Let's look at the next question. Right. Next question. What else? Okay. Greetings. Can event, which is news, affect the market structure the entire week or month analysis? Right. If you have been attending most of the sessions, you realize that what I told you, that most of these guys who give fundamental news events, they are also technical people in the sense that they are aware of what is happening technically. Most of the times they will simply obey or follow or align their movement, the movement that they will give out on the news. Let's say we are in a bullish order flow like this, bullish order flow. Then we have a demand here. I remember last month gold did this similar move that I'm showing you, whereby they were up here before the news. So what news did? They never shifted because according to this, the next buy entry that you must take is down here. So what they did during the news, they dropped like this. They dropped into the zone. Then after the news, they flew up there. So once you are technically now, you are technically a genius, or technically, once you're sharp in technical skills, you realize that news events or trading during the news, it won't be a huge problem to you because you now have this understanding that most of the fundamental data that they come to give you, they would have collected it from technical setups or technical structures. Right. So that was the question. Right. Others, you're quiet. I still want your questions. I still want your questions. Keep them coming. So back to fair value gap. I saw a video online where they said that some of fair value gap doesn't know what are the major aspects to look for when drawing trend lines. You're asking two different things at once. You're asking different things. What are major aspects, some of your questions, to look for when drawing trend lines? Trend lines, okay. Trend lines that are going to hold are trend lines that are aligned, that align themselves with the structure. Trend lines that will hold. If you go to the chart and you draw any trend line and you see that trend line aligning itself, or that trend line being respected, know that trend line was aligning itself with the structure. Let me give a simple example here. Here, someone could have drawn a trend line like this. Well, someone could have drawn a trend line like this. Someone could have drawn a trend line like this. A lot of trend lines could have drawn here. So meaning, if ever you drew this first one, you broke out, came back to retest. That's your trend line, right? So meaning upon the retest, you are entering, right? Which now, once you now have institutional understanding, you realize that they will wipe all this. This is an inducement. They were bound to come and wipe it out before they fly all the way to the upside. So you discover, so long we are below that inducement, if you go to a lower time frame, below that inducement, you will find a zone, your demand below that. Let me just go to 1 hour or 30 minutes so that you see. So what I'm simply saying is trend lines, there are trend lines that will not hold. There are trend lines that can hold if they are aligning themselves to structure. Remember, trend lines, they don't define structure. They are simply trying to define structure, but they are not the structure. So the trend lines that you see being disrespected are trend lines that are not aligned with the structure. So in this case, someone could have drawn this. Check what happened. They broke above, they broke below, then they kept on going up. So in this case, if you zoom in, this was the zone. There was a fair value gap as well as an order block there. So you could have marked your zone like this. You could have marked the fair value gap as well as the demand. So the demand is within the fair value gap. So you could have marked your zone, your entire zone like this. Having this understanding, even if you draw this trend line, right? There's no way you'll find yourself buying here, simply because according to structure, there's a fair value gap. There's also an untapped demand there, which the institutions love to bring price breakdown into a discount before they fly up. Meaning this trend line already, that way is irrelevant. Unless now, if you came now and do this. So if I do this, this trend line was respected because right now it's aligned with structure. Structure, according to structure, they left a demand, they left a fair value gap there, they left an imbalance. So they left out an inducement which they must come and take out before they go. An inducement is simply to induce early buyers. So once you have this understanding, you realize that trend lines, you can draw trend lines, but you don't really need them for you to know how the market is moving, where the market is going. You might not even need them. So even this one, this trend line, when it was broken, came back, the market, someone could have bought there. Of which, according to structure, according to how institutions think and how institutions move price, they will take you out. They use you as liquidity there. You will be used as liquidity because this is inducement. So long you are trading above inducement like that, we are trading above liquidity, that's equal loss as well. So long you are taking trades above there, you are still at a risk of being taken out. Right, that's the answer to that question. Because I've been trying this Matengo. Those are just names. Guys. Even tomorrow, I can even wake up and give my name as a strategy and say King Michael strategy, King Michael strategy. Those are just names. Those that are in the class, they are aware of what I told them. I think a few weeks ago, where I said, don't call yourself a price action trader or an SMC trader or an whatever trader. Just call yourself a trader. I'm a trader. So me being a trader, it means I must understand the market fully, as raw as it is. If ever I have to understand it to 100%, let me understand it to 100%. Once you call yourself a price action trader, you call yourself an SMC trader, there are traps that are simply designed for price action traders. There are traps that are designed for indicator traders. There are traps that are designed for so-called SMC traders. So once you call yourself a trader and you start to look at the market as raw as it is, you discover that most of these names, but it doesn't work. How can I advance on that? Let's say the market is on an uptrend. How do I maximize my profits using either those are just names, my brother. Those are just names. Those are just names. I always tell the people in the class that don't be confused with jargon, trading jargon, whereby someone comes and explains liquidity in a very huge word, which is not liquidity, but simply him talking about liquidity. Can we confirm a breakout structure? No. If the market came to this low, went up, then they come here, reject here, and close above. That market, it didn't break out here. That's not a breakout. Breakout the body of the candle. The body of the candle must close out. In some of your session, you say we have types of adjustment like trend line adjustment. And those are liquidity, not adjustments. Trend line liquidity, not trend line adjustment. Can you please state other adjustments that we have to take note of? Those are liquidities. I say that we have trend line liquidity, we have equal highs and equal lows liquidity. We have high and low liquidity. Trend line liquidity, with equal highs and equal lows liquidity, equal highs or equal lows. We also have high or low liquidity. High or low, this is your swing high or your swing low, whereby they can come all the way to the swing high, wipe liquidity, close above, then they go. That's also another form of liquidity. They come, they reject, they close above, then they fly. That's another form of liquidity. It's liquidity, not inducement. Say, can I use trend lines, bearish or bullish engulfing candles and market section determine where the market is going to go next? Trend lines, they try to define. They are trying. You people, you don't listen. Trend lines, they are trying. The same way moving averages and indicators, they try to show you where the market will go. But they are not the market. And they don't detect where the market will go. They actually follow behind the market. Even trend lines themselves. Trend lines, they try to define the market, or they try to define the structure. They are not the structure. That's a point that you must know. Even if you are going to use them, you must know that they are not the structure. If a trend line is broken and structure is not broken, that trend line is good as useless. If a trend line is broken and structure is not broken, that trend line is good as useless. So I'm not saying stop using trend lines. Hear me clearly. I'm saying trend lines, they try to define the structure. So even if you're going to use them, you must have that understanding that they try to define structure. Don't make them your entire bias or your entire focus. Say, for example, here, let's say someone can draw a downward channel like this. Okay, we're coming down like this, coming down. So if you're doing like that, so it means if we break out there, we're not going up. Okay, slow down. Let me show you why this is wrong for you to say this. The reason why it's wrong is, remember the point that I stated. If a trend line is broken, structure. If it's not broken like this, what is going to happen, my brother, there? These guys will deal with you thoroughly. Most of you are still making this same mistake that I'm showing you now, whereby the trend line has been broken, but structure hasn't been broken. There's still a bearish market. They came, they continue going down. If you want, I can give you proof of how many times the market does that. So many times, so many instances I can give you. So many instances I can show you. The best time frame, the higher the time frame, the better. The higher the time frame, the better. The higher the time frame, the stronger the zone. The higher the time frame, the stronger the zone. So you discover that 4 hours, H4, 4 hours, H4. H4, that's where your main analysis, your main structure must be there. Daily 4 hour, that's where your main analysis must be on. That's where your main zones must be on there. Right. So, as I was talking about, what was I talking about? I was talking about breakouts, whereby they break out of the trend line, but they don't break structure. They break out of the trend line, but the same. Look at this simple example here. Simple example. Guys, we're in a downward channel. Now we've broken out of the downward channel. Now we're not going up. My brother, slow down. Going up where? Where? Where are we going up here? Where are we going up here? Where are we going up? So you see that this is 1 hour. It came, the close, came. So according to them, the previous swing lower let's go to structure now. This is our lower high. This is our lower low because it shifted this internal order flow. This is a lower high because it took out that. So the next leg that we'll need, it means, is this, whatever happened inside here, this confirmed this low is a lower low. This one. Like that. This internal break like this. So this as well is not even considered as a lower high. The reason why it's not a lower high is because it also failed to break down here. He did broken, it was going to be. So in this case, that's why I said structure is very important. So this is actually our internal lower high. They came and took out this. So meaning, what does it mean now? Them taking that was the confirmation to say they are now a lower high. Them taking out this. So meaning, our internal lower high, internal, not the external. This is an internal. So the external one is that one. So meaning after they took out the internal like this, they are simply confirming this low as a swing lower low because it's lower than this. That highest point is now your lower high. So you see now where most of you are getting things awkward and wrong. So in this case, someone could have said, guys, we broke out of a downward channel. So we're now in an upward channel. We're now going up. But check now. Never. Someone could have targeted the highest point there as a target. But you check, it never went all the way up there because structure was still bearish. Structure kept on being bearish. Structure. So I can give you so many. Here, someone could have said we broke out of an upward trend. We broke out of an upward channel. So if you break out of an upward channel, what are you expecting? This is what most of you are expecting here. What happened? The opposite of your anticipation because you don't understand structure. Trend lines, they try. Once you get that point, even if you draw trend lines tomorrow, you are drawing them with an understanding. Don't make trend lines your entire judgment or your entire decision maker to enter or exit trades. No. Look at what happened here. Look at what happened here. Here, if you now ask me what happened, if you now ask nicely there what happened was they took out, remember that is now our lower high, right? That being our lower high, I'm just showing you now how we analyze some of us. That's my lower high. My lower low is going to be the low that will shift internal order flow. So this is now my lower low because it shifted internally here. That's a good point. So what does it mean? The thing that I was explaining to you that what the institutions do, if they break structure, this is an institutional move. Coming from the swing high to take out the swing low like this is an full institutional move. After they are done with this, so long they've zones that were left out, like here, they left out this fair value gap. There's a fair value gap. There's a supply. Basically, I can even mark out this zone from here. I'm gonna show you why I marked it like this, right? So, according to the information now that I'm telling you, I'm saying once we finish an institutional move according to structure here like this, and that person who is drawing trend lines, they don't even look at all of that. All they're saying is once that's why they're always taking you out every time. Every time you do this, you break out of a trend line, you come back to retest, you sell hard, they will wipe you out nicely. You don't understand structure. According to this was actually a buying moment. So you realize that the same time institutions are buying, you are selling. The same time they are selling, you are buying. Like this. Simple. The trade that you're supposed to take in this particular case, the trade that I was going to take is this one. I was going to take the buy because I'm simply explaining structure to you now. So in my case, remember what I told you about the two forms of trades. We have liquidity generating entries as well as the liquidity collecting. This was a liquidity generating buy that I could have also maybe entered with and minimized the risk. We broke out here. This one, I don't apply a lot of risk there on that liquidity generating. Yes, we have finished an institutional move and now we anticipate a pullback, right? We have finished an institutional move. That's a good point. Now we're anticipating the pullback before the continuation, which is good. But do we know that they are going to pull back from here? The only confirmation that they were going to pull back from there was after the establishment of this is our lower low. How was this established? By the shift of internal structure. After internal structure was shifted like that, that was when. Now, if ever you're going to take any buys that you take, so long we have an untapped zone up there, any buys that will take up down here, we're going to target the top there. That's why even I spoke about the concept of Fibonacci, whereby I now have my lower high, my lower low is now this one. This is now confirmed as a lower low after this break. So the best entries that you could have entered there were the entries after this was confirmed. After they confirmed this as our lower low, it means any form of pullback down here was going to give us our entries up. So you notice that these equal lows, what I was talking about is liquidity. Equal lows here, this is all liquidity. Look at what they did. So they came, wiped out all these equal lows, tapped into a demand, and tapped demand, then flew. That was a high probability. So this was the best opportunity that you were supposed to take. Whilst so many retail traders was busy selling here, the ones who only understand trend lines. If you find someone who will tell you that trend lines work, go and correct them and say they work depending on the market condition. They don't move price, this trend line. They don't. So most of you are too lazy now. Why am I saying you're too lazy? I'm sorry to say this, but that's the honest truth. Most of you are too lazy. You don't go deep when it comes to your analysis. You only want shallow things. You come here, you draw this channel. We're in an upward channel, when you come down, we'll buy. You buy here, they take you out. You come here, you sell here, they take you out again. Because you don't want to learn. You don't want to learn, and you don't want to understand the real dynamics of price, the real dynamics of the market. Once you understand the real dynamics of the market, you don't want anything else, anything that is trying to define the market, anything that is trying to define price. You no longer care about it. Even here, if you add a moving average here, you realize that by the time, for example, most moving average traders, they will tell you that, wait for the breakout. Once you close above the moving average, that's when you end. Okay. But now you realize that moving average, by the time it will curve, the market would have moved a long way, a huge way. So these things are trying to define. Once you have that understanding alone, once you come to total acceptance of that fact, let me put 50. Let's see, 50, 50, 50, 50, 50 exponential. Okay. I've just put the 50 for 50 moving average. It's also a common moving average like this. So what moving average traders do, after they broke out above here, they are busy buying. Here they buy, here they buy, here they also buy. So here they bought here. Our moving average, guys, is below now. It's below. Market is going up. Going up where? Where? Understand the structure as it is. That's my whole point. Trend lines, they are trying to define the structure. So if you come to someone like me now, if you come to someone like me here, I said this was the trade that I was going to take. But if you tell that same trend line trader or that same moving average trader that I'm entering a buy, they'll actually laugh at you, because themselves, they have lesser understanding of the structure as raw as it is. Once you get this understanding, once you have this understanding, ladies and gentlemen, you're now something else. You're now dangerous. So, which is the best time frame? I answered that one. I said the higher the time frame, the stronger the zone. So make sure that your daily and your 4-hour zones, make sure you draw them. You draw those ones. Your daily and your H4 zones. For example, right now, H1. H1 is also not a bad time frame for zones. So even H1, you can use it for entries, 30-minute. So meaning, if we tap into our H1 zone, you can even start entering your trades. H1, H4, make sure your zones are there. H4, make sure your zones are. I'm confused. I'm not sure that I see really correct that there's a minor change. Please tell if I see it. I don't understand this question. Some of the questions, let me go to VIX75. All right. I feel like there are people that they haven't asked anything here. Yeah, 30, but the number of questions that I've seen so far, it's lesser than the number of people that are here. Some are just folding their hands passively. It's okay. It's okay. It's okay. It's okay. I don't have an issue with that. But at the end of the day, opportunities, they come once in a while, especially these opportunities where the truth about the market is really being shared. They don't come every time. It will come a time where you miss the question and answer session, or the opportunity to ask a question. You will miss it big time, because there won't be that time won't be there anymore. That time won't be there anymore. Right. So while this is still here, try and ask as many as you can. Try and ask as many as you can. So down here, I said they left in a demand. Down here, definitely they're coming back because of all the reasons that I stated. They left a lot of liquidity. There's a lot of liquidity. Equal laws here, like this. Equal laws, adjustment. So the move that we're anticipating, because we have finished an institutional move. This was an institutional move. From this swing low, to take out that swing high. That was an institutional move, right? That's point number one. Point number two, they've finished this institutional move and they have generated liquidity. This is liquidity that has been generated in form of equal laws as well as inducement. Number three, we have an untapped demand, which is where we are targeting them to come down and fly up. So the move that we're anticipating on VIX, what does it mean? We are still anticipating that swing sell that I spoke about. It's still there. It's still there. It's still there. Let me show you why I'm saying it's still there. Because remember now, this is which time frame is this? This was the previous. This was the previous. There was a break of structure. They came lower high, lower low, lower high now. So now you can see that they are forming bullish order flow. So they are still yet to create a higher low. They are still yet to create a higher low. So in this case, let me now put. So this was the lower high that was changed character here. Them changing this like that. That was a major change of character, because this one was the minor one, whereby inside they changed. After they changed inside, they qualified this as a swing lower low. After they took out this, they qualified this as a swing lower high. So it was like that. So now there's liquidity. There's also an untapped zone. So up there, you realize that we have currently where the market is a supply zone. Do we have any other supply zone? Other one is way up there. Right. So in this particular case, we are currently at this block. So long this block, so someone, let me go back to the question, what the question was saying, so that I don't go off topic. I'm not sure that I see really correct that there is a minor change of character. Please tell. Minor change of character, where, to the upside or to the downside? That's the question. Minor change of character, where, still. So here, that bearish expectation is still there. Still there. Still. So here, from there where it is now, the anticipation is to the downside, because to the upside. The change of character that happened to the upside is this one. This is the major change of character. The minor change of character that you're talking to the upside, the minor one is this one below here. So I don't know what you're talking about now. This is the minor change of character that happened to the upside was this one. This one is the major one. Minor and major. Like that. So from where it is, that's a supply zone. Supply zone. They've collected liquidity also here to the upside. Equal highs. You can see equal highs here. There was a lot of liquidity up there. A lot. Liquidity. So where it is now, which is a supply zone, so long they don't break there, 15 minutes. Hear what I said about time frame. I think I spoke about time frames, that H4 and H1 must, your main analysis must always be there. Daily H4, I'm going there. You realize that even on 15 minutes, you labeled wrongly. Even on 15 minutes, you realize that you labeled wrongly. Because if you can't talk about a change of character while it's a bullish move, A change of character, you find it on a turning point where the move started, not where when the move is already happening up there. Then you say, I see a change of character. Continuing. If it's a continuation, it will be a break of structure, not a change of character. It will be a break of structure, not go to ensure that what you call pullback before continuation going down. I'll go to that just now. I'll go to gold. I'll go there. So here I'm saying this supply, so long this supply is not broken, this movement, I'll ask you, what did they say about this one? So the only thing now is to fully wait for a full confirmation. A full confirmation. And let me go down to lower time frame so that I show you. 4 hour, if you go, they haven't shifted from bullish to bearish, which is a lack of confirmation. So that's our zone. I marked that zone based on the daily. Then if you go to 4 hour, you realize that maybe it's a bit, maybe let's see. Let's see where it is on the 4 hour. Yeah, it's the same zone basically. Right. So on the 4 hour, which level must they break? Because if you follow internal structure, you realize from this leg went up, went down, went up, down, went up. So meaning where was our last internal? Our last internal. Follow structure. When you follow structure, you realize that our last internal was basically this leg. I'll show you why I'm saying it's that leg. So it's like this, tap, tap, low, broke structure here. After break structure, also broke inner structure there like this. So meaning this was the, so even here, you can put it here. It's actually here like this. So whatever was happening here, this is considered as one single move like that. So what is going to give us confirmation to enter here? Once on lower time frames, you get a shift up here. It means you can safely enter. Once you enter there, then once you get this shift, this is a full confirmation that we are indeed now going down, which is what we now want to see. If that one hasn't happened, there's no major movement that will happen anytime soon. We'll simply be waiting. So that's the major level that it has to fully break according to the 4 hour. This one. So according to 1 hour now, you go to 1 hour, you see some details that you are not seeing there. Because on 1 hour you realize that this was the internal, this was the previous internal higher low. Was the one that broke structure like this. Let's go down to 30 minutes. So all those levels, they must be broken now. It must come down breaking levels. Come down breaking levels. Up there, you'll find that there will be 15-minute or 30-minute zones up there that you might not be seeing on what do you call this? So this is the previous internal higher low like this. The reason why some of the sales that you took last week didn't hold was because full break, a full break or a full shift in order flow. It did not happened. It was really struggling there on that zone. So 30 minutes, you can see this was one move to the upside, came down. So already, let me go down to 15 now. That's where I'll stop. I'll stop on 15. I'll stop on 15 minute. I'll stop on 15 minute. So 15 minute, someone can come and say, I see this. There's nothing wrong with this, right? But remember, our major level that we want to be taken out is this one. Meaning, if we're going to take any trades up here, you are targeting this level. If they come to this level, maybe this demand, and fail to break here, they'll simply tap there and continue flying high. But if they come and take out that one, they're now coming down. So here you can see they have already generated liquidity, equal highs. So meaning this trade, if we're going to take these sales for now, our first range of focus is still within this vicinity. This like this. like this. This is our structure now. So this is your current structure on VIX75. Higher high, higher low, higher high. Why is this also a higher low as yet? Because it hasn't taken out this high. So in as much as they haven't taken out that in sub-internally, they've already done a change of character. Change of character, and they've already generated liquidity. Meaning our best selling zone will be this one, targeting this level. Because once they come here and fail to break, they'll keep on going up like this. So that's a best selling zone is around. Once they come and take out this, now we will be going now. So that's I hope you answered the day. I hope you answered to say. I hope you answered. Were you answered? 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 Right. This is gold. Let me remove this. Right. Gold. Gold is it a very interesting zone. Right. So what I was saying, I remember there was a question that was asked about news, whatever, or news, something about news, something to do with news. Question was asked about something to do with news. Right, let me see, let me see, let me see, let me see. Right, so there was this one. I think it was, when was this? Right, it was here. Right, it was exactly there on that yellow zone. So I remember last month, I mean this month, which is October. Let me go back to this question. What does it say? Code on H4, is that what you call pull back before continuing going down? Okay, let us go. Because if you go to the daily, you see a clearer structure more than what you're saying. When you see things wrongly, it's because you are focusing on a tiny time frame. When you go to the daily like this, you realize that this is the real structure right to the left. The broke structure, internal change of character, making that a swing, higher high. This is a high, that's a higher high because of the shift internally. Shift internally, it happened here. After the shift internally, they kept on coming down. They came to the swing, higher low, which is just here. Then they flew up because they are respecting the external structure. That's so simple. So meaning here, your entry was going to be here, stop loss below. For targets, you can target any zone that is above a liquidity zone. I'm not giving you dangerous information now. Any zone that is above a liquidity zone, use that as targets. The market will always reach out for those ones. If you notice here, this is liquidity equal highs. The supply is on there. That supply was the best major first entry because from there, it can give you a potential pullback before it continues higher. Before it continues higher, if it wants to keep on respecting the external bullish order flow and also internally, which was where was your previous lower high internally? Was this one. They've changed this one. So meaning this change of character is the same with this one. Same, like this. So having like something like that after we've tapped this major supply, which is also above in liquidity zone, right? So if ever we're going to have any form of pullback, because now remember they have shifted this internal. This internal is now in alignment with the external. External is bullish, internal is now also bullish. How have they confirmed? By this full institutional move where they come from the low, they take out the previous high, which was a full institutional move. Remember what I've taught you, once you see a full institutional move, always anticipate a reversal before a continuation. Reversal before a continuation, something like this. So if they want to continue being bullish, there is a major demand that is here below here. There's a demand that is here untapped. There's also this one. Remember what I've taught you about the zones, that so long there's a zone above a zone, so long there's inducement or liquidity above a certain zone or below it, In this case, there's actually inducement above that zone. So meaning this below zone is much more going to be respected more than the above zone. This one, it's simply at a point where, but you can mark it like this. Marking it like that, it will help you to even lock profits as the market will be coming down. As the market will be coming down from where it is now, it will help you to lock profits as well as maximize on opportunities as the market will come down. So here in this particular case down here, as I said, like this, let me mark my zone properly. So I can mark it like using those two H4 bearish candles like this. There's also, you can see that here we have fair value gap, fair value gap, we have a zone there. That's our high probability zone that we're anticipating to come to. So now, in order for it now to also come down there, they have to shift also internally here before they come down. So internally, I'm referring to anything like this, whereby if they were coming up like this, for them to come down, they have to shift internally, something like that. Something like that. So up here, you don't need to know your structure well. Knowing your structure well is you simply knowing. So in this case, this is your previous higher low internally. Meaning if ever they're going to go, if ever gold is gonna go down, it must have broken this zone. But that's the 4 hour, even if you go down to the 1 hour. So meaning if ever we are going to enter anywhere above there, that trade is still stuck within this range, because if it comes here and fails to break, it will still keep on going high. Because this 1 hour, 1 hour, if you notice the internal, sub-internal level is this one. Then once you go lower, you realize that there will be levels up there. That's how time frames confluence one another. So if it comes and breaks all the levels, it means also good for us. So this is the leg on 30-minute, which I'm also looking at that it must break. If it doesn't break there, it has to create a new level. But let's say it plays around, plays around, plays around, plays around, plays around, plays around. Once it does something like this, you know that your new level will be this one. So gold, still a very good setup, basically, a very good one. But that's the answer to the question. Are we together, ladies and gentlemen?
Yebo.
Wonderful, wonderful, wonderful. So I think, did you gain anything? Did you gain? I want to hear now from people. Have you gained anything from the question and answer session? Did you gain anything of value? If not, say I didn't gain anything.
We did.
Okay. Others are quiet.
Yeah, we gained a lot, Mr. Mike. Thank you.
Wonderful, wonderful. Others are quiet. Others are quiet. I'm worried now. A lot.
Thank you for gold, sir. Thank you for answering my question. Thank you.
Wonderful. We did learn quite a lot. Wonderful, wonderful. So you're entering a new week with enlightenment.